There is an endless sea of podcasts about entrepreneurship. Talking about it, but not living it. We live it every day. This is Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkle, talking about real estate investing, but also encompassing general subjects in regards to owning small to medium-sized businesses. And of course, all the struggles that business owners must overcome to be successful. This is Inside the Wolf's Den. And this is Shawn and Joni Wolfswinkle.
Welcome back, everyone, to Inside the Wolf's Den. I'm Joni Wolfswinkle, and my other half, Shawn Wolfswinkle.
Hey, everybody.
How are you doing today, Shawn?
Doing great. Yeah, great start to the week.
Yeah?
Good week, yeah. How about yourself?
Doing good. It's crazy that we are the last quarter of the year. Our theme for the rest of the year is to finish off strong in our company, so hopefully our listeners are also finishing off the year strong and
making the most out of this year for sure.
Yeah, for sure. So we're on episode 27. Kind of crazy to think. So we're actually going to dive into real estate and take a deeper dive into buying, managing, and selling residential real estate. It's going to be a 5-part series. The first one is going to be real estate cycles and is now a good time to buy, right? The second one, choosing a market and properties. Third one, your real estate team, so lenders, contractors, title companies, your realtors. And then the fourth one, my absolute favorite, property management, the key to making it all work. And then the fifth one, when to sell, refinance, and also going over 1031 tax exchanges. So that should be a pretty awesome series. And
next 5 weeks, I think it'll be a good little series and give the listeners a good understanding of kind of what we do and where they are, and maybe they're just checking it out or thinking about getting into rental real estate, but a good breakdown of each one and going a little bit deeper than we have in the past.
Yeah, so stay tuned and listen into the next 5 series. And one of the questions I want to ask, I know that this question you probably get daily, is now a good time to buy? Yeah,
I mean, we're, to give you background when we're recording this, we're at a time when, number one, we're in the middle of COVID, but that besides that, we're at an interesting time. Like, we've had a really, really long run in real estate. So, the real estate goes through cycles, and I'm going to break down the cycles here in a minute, but typically a full cycle will be about 8 to 10 years, and then it repeats itself. And so, if you really look at the past and look and study different real estate cycles, typically it's 8 to 10 years, and then, there'll be a recession, a recovery, an expansion, a hyper supply, and then a recession again. And it's always repeated itself, and it's been the last one was 2008,
right.
Roughly. I think in Texas, we kind of felt it in 2010, maybe a little bit later, but the bulk of the country felt it in 7 and 8. And then we've had a really long run. So it's been 12 years now. And, you and I were both thinking like, we were nervous, or cautious is a better word to say.
Yeah, because we had never been through something like that. So we're wondering what's going to happen, you know?
And it had been 8 to 10 years. So we're like, okay, we're due for one.
Right.
And so we, even before, COVID hit, we took a cautious approach.
Right.
Yeah, we actually cut down our buy and sell business as far as real estate, how much we were building.
Conservative on our numbers when purchasing.
Yeah, so we really contracted and tightened up our stuff and tightened up our employees and, went to just the essentials because we were just prepared like, hey, we're due. But we didn't know what was going to cause it because last, in 7 and 8, it was a mortgage meltdown, that they were just giving anybody a loan and it went crazy and there was a huge boom, but then it wasn't backed by anything solid. So then, it all collapsed. It was a house of cards and everything came down and some markets dropped to 50% in value. It was an interesting time. And right now we don't know what would cause it. And then COVID hit.
Yeah. pandemic.
In the pandemic. And I think that's what's probably going to put it over the edge finally. And so I think that's kind of where we are right now in today's time, even though, and we'll get into that, because even though right now, as we're recording this, the market is hotter than I've probably ever seen it.
Yeah.
And just weird time, or at least as hot as maybe 2007 maybe, but it's a weird time.
Yeah. So take us into the cycles, the real estate cycles.
Yeah. So there's 4 different cycles that the real estate market's going to go through. So we're going to start off with recovery. So this is when, you just had a recession and the market's starting to recover. So you still have high employment. There's not as much consumption out there. People aren't buying houses because they just lost, their shorts, or they just, there's a lot of news and negativity. And so, the news is always talking about either really negative or things are so great. And so different cycles, you're going to get different news, promoting different, messages out there. So, the consumption is going to be low. You're going to have a decrease in investment in buildings, land, factories. And you're not going to see any new construction, because new construction just took a brutal hit in the recession.
Yeah.
And so, they're licking their wounds and they recovering. And right now they have no projects that they're building. They're just recovering from what they had, probably trying to liquidate still some of the old stuff they had. But in this cycle, they're going to be not starting any new ones. They're not going to be acquiring any new land or going through development. So the recovery, there's just not a lot going on. Very flat market in most cases. Then there's expansion. So occupancy and rental rates start to rise. Real estate related profits start to rise. So meaning as prices start to increase, the deals become more profitable, so attracts developers. So, if the price point of real estate starts to increase, developers see the opportunity to develop land that maybe they were sitting on, and the profits start to increase for them. So it's more attractable. So, but the problem with that is I don't even know, attractable is a word. It's just more attractive.
It sounds good.
It sounds good.
Run with it.
Yeah. More attractive. It was what I was trying to say. But what happens though in this cycle is that these projects take like 3 to 5 years to develop. I mean, it doesn't happen overnight. So even land that they maybe have already acquired and own, they still got to put it through all the permitting process and the different reports that they had to get to make sure that land's buildable and all these things. It takes a really long time. And like even for us, like even when we're building on infill lots, it's taking
to get out of permitting.
At least 60 to 6 months just to get through permitting. That's something that the lot that's been there forever, and it's already. We're talking about tracts of land that need to be developed.
Yeah, makes sense.
And so it takes a really long time, and so things are starting to get more positive. Unemployment starts to drop. There's a boom in new housing starts, declining vacancy. And finally, new construction gets off the ground, and you start seeing more during this time. Then there's hypersupply. So occupancy rates exceed long-term averages. You have an increase in unsold inventory. You have an increase in vacancies, and a lot of new construction on the market. So now that all those developers and all those builders, they finally out of permitting. They're finally cleared their lots. They put in their streets and utilities. And now they're building. Yeah. And then there's a surplus. There ends up being too much on the market that they can't. And so there's a hyper supply of inventory on the market.
Yeah. Well, if you can recall, in I think 2005, we had purchased some properties and overpaid for properties and dumped a buttload of money into them, and it's like, crap, what do we do with them now? We can't sell them, you know? And
we were upside down on them.
We were upside down on them. So we thought, well, let's rent them, So we leased them out for a good 10 years and sold them in 2015, right?
Yeah.
And so we made pretty good money off those.
I think all those houses
doubled
at that
least.
time. Yeah, they at least doubled. So we held a bunch from 2005 to 2006, 7. And they did incredibly well. I would say all of them doubled. We use a lot of that to 1031, which we'll talk about later in a different episode, into some apartment office buildings and self-storage. But
so we bought at the top of the market
Yeah. So
Right.
bought at the top and we rode over 'em.
Rode them until we saw the correction, and then sold them. And
I think that's the beautiful part
expansion.
about real estate is that in most cases, time can cure a lot of mistakes.
And we were, floored when we saw, like, wow, like, yeah, it was a good choice to hold. At the time, we thought, man, I guess we'll just keep this as a rental, because we couldn't sell it. But years later, we're like, why didn't we do that on more of those?
Why don't we keep all of them?
Yeah.
That's a good topic for another time. And then the last cycle is recession. So, this is kind of what a lot of us are expecting to happen. A lot of us are expecting to see a recession now after COVID. And once the government spending, we're just about there, completely runs out, the elections are over. What are we going to be going into next year for 2021? What's going to be the outcome and from that as far as the real estate market, economy too is going to be probably in pretty bad shape. But
and we can all agree that in the recession, every market is unique and different. We've had friends in different markets that 50% of their values went down.
A lot of the coastal states.
And we get this question all the time, like, how was it in Texas? How was the recession in Texas? And we didn't really have the massive ups and downs. I think at most 5% we saw.
Yeah, about 2010, I think we saw about a 5% correction, but it was minimal, and we were the first ones to recover. So every market's different. We saw that oil boom.
Yeah, we saw the big oil boom, and that's kind of what carried us through.
Yeah, carried us out of the recession. That's what helped Houston in that time, be the first city to get recession numbers, after and we corrected and then rebound quickly, and then we ended up on a real big run for the next 4 or 5 years after that.
Yeah.
But I think every market's different, and you're gonna have to look at your specific market. There's macro numbers, and as far as the whole country, and then each state has stuff going on in them, and then each city is unique and different. Even within Texas, out of the 4 major cities, Austin, Dallas, San Antonio, and Houston, they're all different.
They're all different,
They all have their unique things.
Absolutely.
Austin's much more expensive than like Houston. Dallas is a little bit more expensive than Houston. And then within each city, there's certain neighborhoods that do better than others. There's different levels of economic, levels within the city, and so different areas are going to do differently across the board. So you got to really look at it and look at it in detail. What areas you're looking at, what's going on in that particular city, what's going on, and the biggest thing and we'll get into this when we're looking at markets and properties to look for, is you want to go where the jobs are going. And so you want to look at what cities are attracting, or what states attracting jobs, where are people moving to, where are companies moving to. I think that's going to be the biggest indicator for you, and the biggest decision when you're looking to invest in another market is really where follow the people and follow the jobs.
Absolutely.
Because that's where those houses that doubled in value, part of that out of the last recession was, for us personally, that's where we invested in parts of the town, and we invested in Houston, which we were throughout that time from like 2010 to I think it was like 2015, 16, Houston was one of the fastest growing cities in the country. We had the highest job growth and people moving to our city than any other city in the country. So that's what helped us boom and helped those properties double in value as quickly as they did.
Yeah.
So
I think looking at it, it's fair to say that it is a good time to buy, right? We've been at this 20 years now, and the interest rates are at the all-time lowest that they've ever been.
Yeah.
So if you can find, a product that has good management behind it, I think it's a great time to buy.
So, I want to give you an example of that. And we're at a extremely unique time, because it's, all that's gone on this year, but also interest rates are all-time lows. Like, I've never seen this ever at this low in 20 years. And, when Joni and I got started 20 years ago, our first mortgage we ever got was at 8%.
8%. Yeah,
and we thought like, man, this is it. Like
we're on top of the world.
Yeah, and we thought it was such a great, it was a
Yeah.
great interest rate at
Right.
that time. And then, several years later, even when we got like 6%, we're like, wow, I don't think you can get any lower in this.
And then 4%.
Yeah, and then now we're in the 2s for owner occupied, and in the 3s for rental
Right.
real estate. Our clients are locking in the 3s, which is just unreal.
Yeah.
That's part of the reason we're seeing a big increase in demand. But yeah, we're at a time right now that we're probably hyper supply, maybe headed into recession. And so one of the questions I get over and over, at least every day, if not every other day, is should I buy now or should I wait?
Right.
And
that's a question you get daily almost.
And so I want to address that and talk to you that
so break it down to us.
in any real estate cycle, I think you can make money at any cycle, and I'll get into a couple of them. But should you buy now in a time where we might be entering a recession? So I'm gonna give you an example, and hopefully I can explain this because there's some math or numbers, and so I know you driving or listening might be hard to understand, but
keep it simple.
Keep it simple. So let's just say you have two options here. One is, should I purchase a property now and ride it for the next 10 years, or should I wait 5 years and let the dust settle, and then I'll enter, and let's compare where you'd be at the end of 10 years. So if you bought now and had a property for 10 years, or if you waited 5 years, sat on the sidelines and then bought, and then where you'd be in 10 years from now. So if that happens, so let's say you bought a property now, and let's just use our duplex as an example. So they sell for $285. Our clients are locking in at 3.5%.
Okay.
They're putting 25% down. So their cash flow on that is about $7,668 per year. If you didn't do anything, like we're going to take some hypotheticals when doing this analysis, is of course you're going to get rent increases over the next 10 years, but I'm not going to factor that in.
Yes.
Probably taxes are going to increase over the next 10 years. Insurance is going to, insurance is going to, now
right.
that number, the 7,600 includes maintenance allowance and vacancy allowance. Okay. So we factor that in. But, taxes, insurance probably going to increase, rent's going to increase. But we're just going to act like you're just going to get $7,668 for the next, every year for the next 10 years.
Okay.
So total and cash flow that you're earned for the next 10 years is about just over $76,000. Now let's say over the next 5 years, because we're entering a recession, you lost money. So let's say your house goes down 5% over the next 5 years. You would lose $14,250 in equity because your property depreciated because of the market.
Right.
But then after the 5 years after that, so year 5 through year 10, it gains back 10% in appreciation. So now total over those 10 years, you've gained 5% in appreciation total. So you've made $14,250 in appreciation over that 10-year period.
Right.
Correct? Plus your tenant paid down your mortgage $48,391 over those 10 years. And the beautiful part of that is once you get 10 years, you're already 10 years into that mortgage. Right. So now you start to really
paying it down.
Because if you ever look at a mortgage amortization schedule, the bulk of the interest is paid up on the front end. So once you get past year 10, year 15, you really start to see a lot of that go towards principal. So you're already 10 years in. So you're going to see benefits there. But the total in equity and income that you would have earned for that property over the next 10 years is about $139,321. Now let's take the other side. Let's take it. So now you said, you know what? I'm going to wait 5 years. And I'm just going to sit on the sidelines. I'm going to see how things go. Just keep working more I'm working. I'm not going to do any investments in real estate. Let's just see how this plays out. So now you waited 5 years to buy, and you buy year 5 a duplex, same price. And I'm going to assume that it's the same interest rate. Now, I doubt that we'll see 3.5% ever again in my lifetime. But so it's probably going to be higher. But I'm just going to take it that, hey, the government, we're in a recession. The government's just going to leave the interest rates where they are for the next 5 years, which I doubt that will ever happen. But we're going to assume that for this example. So you buy it for $285, and number one, that's assuming that I didn't raise my prices in 5 years.
In 5 years.
But let's assume everything's the same. So $285, 3.5%. the total that you would earn in cash flow over those last 5 years would be $38,340.
Mm-hmm.
Now, you would have made that 10% in appreciation, and you wouldn't have lost anything because you didn't own it the years prior to that.
Right.
So you would have made $28,500 in appreciation. Now for the 5 years that you own it, your tenant would have paid down your mortgage $22,087.
Yes.
So the total for you in 10 years from now would be $88,927 in equity and income.
Mm-hmm.
So the guy that buys now goes through a recession, and in 10 years, or the guy that waits 5 years and then buys, in 10 years, the guy that bought now is almost $50,000 ahead of the guy that waited.
Yeah.
Plus, he's already 10 years into his mortgage, where the other guy's only 5 years. Now you could say, well, hey, I didn't invest that $75,000 for the down payment. So I probably would have got a return on that $75,000 sitting on the side if you were option 2. I agree with you. So there's probably, if you would get in the stock market or saving, I don't know where you're going to invest it, but you're probably going to make some of that back. So, but still, the guy that bought now is probably still $30,000 ahead of the guy that waits and sits on the sidelines.
Absolutely. So the moral of the story, you can buy in any cycle.
Yeah. So with interest rates where they are right now, and if you can find the right product, a good solid product, and a good management, I think today is still a great time to buy. So hope that answers a lot of those questions if I should buy now. And we can, I'd love to take a deeper dive. If you want to chat one-on-one, I'd love to go through that with you. And then the opposite spectrum of this is, like, people might say, well, is buying in a recession, a good time? Like, let's say in the next 3 years, or and you know what? Those are times where you're going to see prices adjust because we just went through a cycle. So now you're going to be able to buy better deals.
I mean, some of our best deals, we said that too. We could, if we would have bought more, we could have, you know.
And it's so buying, of course, you always hear that real estate, buy low, sell high, or buy at the bottom of the market and sell at the top. The truth, though, is it's really hard to predict those.
Yeah,
and you're never going to be perfect.
On,
and you're never going to, and a lot of people have been saying the top's been the last 3 or 4 years, and people have been selling off stuff, and it's still going.
Right.
So it's hard to predict, and recessions happen a lot quicker than most people realize. They come fast. The market changes overnight, really, really quick. So, that's what I learned from 7 and 8, that it flipped quickly. The mortgage meltdown happened very, very fast. Yeah. And so, but it is now a good time to buy. I still think, I said again, with interest rates the way they are, I think it's still a great time to purchase rental real estate, even in a market like this. Now, if we see a correction or adjustment, over the next 5 years, I think there's going to be opportunities to buy, properties at a better price point. You'll probably see new construction maybe dry up because builders, again, their profits are going to be decreased. So they're going to put a hold on new construction. So a lot of that opportunity is going to be in existing homes and existing inventory is where you're going to probably see the opportunities over the next couple of years. So hope that helps.
Yeah,
hope
awesome.
We'll
Thanks so much for getting deeper into that. I think it's going to be an awesome series. The next one we'll go into markets, choosing a market, and properties. So stay tuned to the next episode. And thanks for joining us, everyone. Leave us a review if you want to, reach out personally. We would love to chat with you guys. Want to give some information where you can find us?
Find us at InsideTheWolfsDen.com. Or reach us out on Instagram, Shawn the Wolf and Joni M. Wolf. So until next time, we'll see you next week.
See you, everyone.
You've been listening to Inside the Wolf's Den, an entrepreneurial journey with Shawn and Joni Wolfswinkel. Tons of entrepreneurial podcasts are out there. Talking. But Joni and Shawn are living it every single day. Their portfolio now includes many franchises and medium-sized businesses. We talk about the trials and motivators of successfully running a business. Join us again soon for another podcast. But until then, reach out on the website at InsideTheWolfsDen.com, on Facebook at Inside the Wolf's Den, on Instagram at Inside the Wolf Den. We'll see you again soon. This is Inside the Wolf's Den. We'll see you next time.